Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Philippe Schulligen. He is an active investor in 2,400 units, a $180 million portfolio, and has raised $29 million from investors. Prior to being a full-time real estate investor, he worked a corporate job in the business jets aircraft industry for over 20 years. He holds a master's degree in mechanical engineering. So thank you so much for being on the show, Philippe.
You're welcome, Charles. Thank you for having me.
Yeah, it's awesome to connect. I know Philippe through one of my mastermind groups, and it'd be great if you could give us a little background, both personally and professionally, on yourself prior to getting involved in real estate investing.
Yeah, sure. You kind of gave the highlights of my bio there, but like to give a little bit color to that, I came to the US in my late 20s. I was born and raised in France. And, I was fortunate enough to be sent by my W-2 company I was working for at the time to the United States for initially a short period of time that, ended up being, the last 20 years of my life. And that's how I came to the US. I currently live in Atlanta, Georgia, with my wife and our two daughters, and I've been doing real estate full time for about 2 years now.
Okay.
And started about 5 years ago.
So when you initially made the decision to get into real estate, what were you looking for? I mean, why did you choose real estate as the investment vehicle when there's so many others out there?
Yeah, I did pick real estate because actually, unlike some more recent period of time, like the stock market, if you look from the 2000s to late or let's say mid 2010s, it was kind of up and down. As you know, with different the .com crisis, the real estate bubble market in 2008 and 9. So it was like a roller coaster for a while, and that's what I spent a lot of time investing in this market without a lot of success. And I was more trying like shorter term trade, so basically more or less time in the market, which is a terrible idea in retrospect. But so I decided, let me try something else, and I wasn't really familiar with real estate at that point. Nor my family barely. I think maybe they had like one rental property or something, but it wasn't like working very well. But I wanted to try something for myself, and I took two bigger pockets to initiate my education back then. And I ended up deciding on, going into turnkey single family rentals because, it fit, a little bit my busy professional life, as well as, I would say my lack of knowledge, to do renovations and so on. So I thought it would be a good fit, but I realized quickly that like the growth, investing that way, it would be very slow to build equity and so on. Especially I was taking, I purchased a couple of turnkey properties in a more stable market, so there was not a lot of appreciation necessarily. So that's why at that point I started to look at multifamily.
Interesting. So one thing before we can transition forward is with your turnkeys, what was the reasoning that you chose turnkey investing versus passive investing? Or did you know about passive investing when you started? Like passive investing in syndications?
I didn't know. That's the thing.
Okay.
I didn't know back then.
Okay.
I didn't know. And it's part of that learning and getting familiar with real estate. And I think it's, you when you build your knowledge, it has to come through layers, right? And I think so the first layer, which I think most of people would think about, like you're buying a house and you're renting it out, right? There are some nuances with that. You can do house hacking, you can do if you buy like a duplex or triplex, fourplex, but I guess now there's also the Airbnbs you could do, that type of thing. But from a scaling standpoint, it's really tough. And and it's by getting familiar with all these things and listening to podcasts about real estate that sometimes you would have like a multifamily syndicator talking about what he's doing, and I found that very interesting. And progressively, it appeared to me that it was probably like a better way to grow my wealth for our family, going that path of multifamily, and especially like the law of averages. The more units you have, the less expensive it is to manage, and the cost of materials and whatnot is going to be lower. And also the risk that you have, because like with my two turnkey single families, like occupancy 0 or 1. So sometimes I'm at 100%, sometimes occupancy, sometimes it's 50%, sometimes it's 0%. And at the beginning of COVID, I was, from an economical standpoint, I had like both my tenants didn't pay rent. So I'm like, okay, well, I'm like economically I'm at 0% occupancy. Wow. So which, and again, like I cannot say on our multifamily it didn't happen, but it happened in a less, much lower rate compared to the overall capacity of the apartment complexes that we had at the time.
So you pivoted to multifamily, and what was your multifamily strategy going in? Were you going to, or did you start finding deals or operating the deals and raising money? Because usually there's you're going to be partnering people. There's many different partners that are working at one goal of acquiring this property and fulfilling this business plan.
Yeah, and actually, like since you mentioned like people who are beginning in the area, before we started the call, I think to share, in full transparency how I started, I said, I'm going to take a course, right? Like some different people were offering courses at the time, and I think it will grow my learning curve, speed up my learning curve by taking a course, rather than reading a book, right? And actually taking that course opened doors to me to, a community within, that group. And so that's how I learned about a multifamily. And then, I started to look for deals. Now, I had a decent idea of underwriting, and how to select the market, and like all the steps. And but I didn't have, like you mentioned, I had a good idea on raising, finding deals, but like raising money, I had an idea how to do it, but I didn't have necessarily the right network. And there wasn't something, being more from a technical background, I was never really a salesman, so to say. And so I definitely needed help, on the raising money side. And certainly, even though I had let's say on paper, knowledge about how to do it, I had never done it myself at that point. So what happened is I found a deal. Interestingly enough, he was on LoopNet at the time, and underwrote the deal, and seemed to make sense. Spoke to a property manager, and confirmed that we're on the right track. And then I went to look for some partners to kind of, let's say, supervise me, like doing all these steps, like because I had not done them before, and also help raising money, and if not all the money. And that's what I was able to do, again, like by joining that course, that network. I had access to people who could help on these in these areas.
Yeah, it's much more different than doing a turnkey where you're kind of by yourself. And yeah, you have a manager because that's who you're usually buying it from. But with the multifamily, the network is required to kind of do deals and to, all the different parts of the deal, and to successfully close and really make money with it.
Right. And actually, I'm also doing mentoring now on multifamily acquisitions, etc. And that's what I say to my students all the time. It's unless you have very deep pockets, right, or a very large network, that is established and like kind of ready to invest, you will have to partner with people to take down a deal. But and moreover, depending on the actual level of experience of let's say the operator or the sponsor of the deal, if they're beginning, they may not have the experience that is required by the lender. So the lender, or they're going to ask that somebody is coming and co-sign on the loan, who has experience, operating apartments, and to make them sleep better, I guess. But yeah, like it's a team effort. It's definitely a team effort.
So let's talk about this. I mean, how have you successfully identified, vetted, and worked with co-sponsor partners? You mentioned one about being in the network group, but obviously, they don't vet you going into a lot of a networking mentor groups for your background so much,
Right.
It's mostly, so.
Yeah, absolutely. So, I think it's a good question. Absolutely. And I think, there are two, but there are two angles to this. So either maybe you want to partner with somebody with like much more experienced, and in that case, you probably should look at their track record, number one, and to see how like how many deals do they have, how many doors, how many apartment properties, and how many deals that they have sold, like a full turn, and did they reach the goals that they set going in, and if not, what happened, and it's important to understand and see what level of experience they have on this. And I would say it's like if you're going to partner with somebody who claims oh yeah, I can raise such and such, like $500,000 or $1 million, well, how many times have they done it?
Yeah.
Right. So it's kind of a simple question, and I would say I use a lot of kind of leverage my network to ask about such and such.
Yeah.
And or if you don't know anybody who know them, then you ask for a reference, that so you can speak to somebody else who worked with them, and make yourself an idea of who they are and how they work, and are they communicating well, etc. So that's that's on the side of more experience. And if you are to start, like co-sponsor a deal with, let's say, people who are more, kind of newer like yourself, I would say, it's like, go like slowly but surely, right? So take small steps, and try to work together, right? And I think it's always better to kind of do form a little bit of an alliance of people to work together. And let's say, we're going to look at 3 different markets, for instance, like 3 different people come together, and whomever find the first deal, we agree to share the responsibilities and talk about it, like how are we going to work together, and spend the time to define the roles and responsibilities before, like, to sign, to take down a deal. That's why, because once you're you're committed, and you're co sponsor and co GPs, general partners, on a deal, that's going to be for quite a bit of time, right?
Yeah. There's so many things there to unpack with people that are interested in reviewing different sponsors for to partner with or to passively invest with. So it can be used many different facets. So Philippe, tell us about, like, have you had any deals fall through or fail? And if so, what were the underlying mistakes that you made or your team made?
I think my biggest fall through is we lost quite a bit of earnest money on a larger deal that we tried to take down, and it didn't work out because I think we tried to go after, like, a larger asset a little bit too early in my career, I would say. And moreover, it was kind of, several, like, new features part of that scenario. It was like a new market, again, like the size, larger size, like I mentioned, it was like $30+ million. And also we wanted to use a pref equity partner. And with, like, our group at the time, and especially, like, the more senior partner working with us was kind of guiding us. I think, like, on the concept was interesting, however I didn't do it yet, and that's something we kind of failed to have a good understanding of the consequences. And we ended up working with a pref equity partner, and not really have a good backup in place. And at the 11th hour, like, basically, like, 10 days before closing, they said, "Oh, we're not going to pursue this deal with you, and thank you and bye bye." And we're, like, shocked, and like I said, we lost quite a bit of earnest money, and that was certainly a learning experience. That's why I'm I always recommend my students to start with something that they know they have somebody that they can ask questions, and who has done that scenario, that business plan successfully. Right.
So I want to ask you, well, 2 things. First thing is that every time I've been involved with a deal and there's the big whale, it always turns negative, where you have one person whether it's one partner that's bringing all the money, or whether you have one investor bringing all the funds, or a large percentage of it, it always becomes an issue. And after the first deal we did like that many years back, and that happened, and we scrambled, but we closed it, going forward, I would always have a silent backup going. And because usually, it's not always that they'll pull the money out, as I found, is that sometimes they want to renegotiate at the last minute. But it's too risky, especially when you have money on the line.
Yeah, and you know what I've learned from another experienced syndicator, you know, actually it's Brian Burke. You know, you probably know him.
He was on the show.
Crisis,
Yep.
Capital, and you know, I was talking to him about our failure. And he said, I mean, you know, obviously he has 30 years of experience, so you know, it's probably somebody I should have consulted with at the time. But he was saying, yeah, you know, you don't want a pref equity, you know, you don't want just pref equity. What you need is pref equity partner, meaning that they must commit, have skin in the game, you know, towards closing the deal, instead of, yeah, you know, they kind of you know, kind of promise to do this, but you know, at the last minute they can still pull out, and they're not going to lose money. And happen, you know, what happened is they just refunded us. We had some kind of deposit with them. They refunded us, and that's it. Now what we should have asked is say, look, okay, we're working with you, and you know, we're going to do the deal together, but you put money at risk along us, right?
Yeah.
Pro rata of you know, whatever we bring it to the table. But that was the right way to do it.
Can you explain a little bit what, for our listeners, preferred equity? So this is something that we've started seeing over the last 3 or 4 years with syndicators, where there's not just, hey, it's an 80-20 or 70-30 split, 7% pref, right? Which was typically how we did our first deal. And now it's gotten where it is, you've gotten, you know, class A, B, C, D, and you've got, you know, some are preferred, some are. So can you explain kind of what that is versus being a regular, I guess you say, limited partner in it and having upside?
Yeah, certainly. So, you know, I think when you look at, you know, what you want to take down, like a large deal, and let's take the example of a $30 million deal, like, you know, a very quick rule of thumb, you're going to have to bring to the table approximately $10 million. And let's say your capacity for raising money at that point is about, let's say, 3 or 4. Right. And so, you know, you have, you're going to say, well, you know, so I can partner with somebody else. We can bring, you know, the rest of the money, or you know, there are different ways to structure the deal at that point. And maybe one way that is interesting is to use pref equity. The pref equity, you know, it's kind of, if you think about it, it's kind of like a second mortgage, but it is not a second mortgage. So when you look at your capital stack, you have like the senior lender, we will have like, let's say, 60 to maybe 70% of the loan to value or loan to cost, right? Depending, you know, if you finance your repairs or not, or if it's a bridge loan. And then, you know, usually in the typical syndication, like you mentioned earlier, Charles, the rest would be the equity from the investors, right? But you know, that equity from the investors, you can subdivide it into tranches, if you will. One being the pref equity, and then being the equity from your investors. And pref equity, they're going to say, number one is they want to be second right after the senior lender. So the first that will be paid from the cash flow will be the senior lender. But then immediately after that, the pref equity partner, they will want to be paid. And that, you know, that's going to be like part of the contract, etc. And like you said, maybe it could be like called like a class A, or, you know, whatever. But they are paid first, and after only you're in third position, there's going to be the equity of your investors, etc. And on that you can do a split and pref if you want to. But so the pref equity partner, so second position is one thing. The other thing is they're not going to have like super high expectations necessarily. So they could charge like a flat, you know, 7, 8, 9% for a period of time. And then there's an option to buy them out. Usually, you know, if you do like a cash out refi, So if you look at it, so the pros are your investors, you're going to have, it's almost like you have more leverage to some extent, which obviously it's a double-edged sword, but just to to explain simply, you're going to boost the returns of the equity. Let's say, like in the example I mentioned earlier, you bring $7 million from pref equity and you have like $3 million for your investors. You're going to boost the returns. The returns will be higher. That's the pros. The cons are you're in third position. So if the deal was not going well, maybe they're not going to be paid for a while, your investors. So it's an interesting, I've heard, some people doing that successfully. And interestingly enough, just as a quick note there, when our deal failed, we had there was another group that we worked with, in parallel and so on, a little bit more established. They exactly had the same thing happen to them with an equity partner, and it failed at the last minute, and they lost like major EMD. So, I guess we are at the time kind of early stage, kind of pioneers at the time. But like you said, now it's more common. But again, it's something you have to be careful about and structure it well and make sure that they're committed to the success of the deal.
Yeah, it's funny. I had partners and they had a deal, and 60% of the raise was done by, they brought in a family office. Let's say the equity needed to close, and it was brought in by a family office. And it was the first time they had done a deal with family office, and it was fine. There was no issues. Deal's still going on now. But the thing though is that to get withdrawals and distributions out to the limited partners in the deal, and initially there's a lot of hoops to jump through. And then also there's like 3 people to sign off on K1s. And it was a lot more in depth because you had the family office with their people signing off. So you'd have the operators, and then you'd have the family office signing off. And there's like, then that was like 3 parts. So there's a lot of different people going on, but you're able to do bigger deals. And then also, like you said, larger returns for the investors that have some of the upside in that.
Yeah. And so, that's interesting, but what you mentioned here, and I think it will be kind of a nuance to what I had experienced, because so understand from what you said is like the family office was involved in at least some kind of approval.
Yeah.
Whereas that with the pref equity partner we worked with, they were like hands off. They're like, we give you the money, so we signed the papers. Obviously, I'm sure there was like some kind of step in, if the deal was not going to go well, and they could take over. But otherwise, they were like, we give you the money, we let you work. If we're cashing our 7% or whatever the number was, and we leave you alone, and we just have a contract, and that's it. So that's why I kind of made the comparison to kind of a second mortgage, even though it is not. They're not on the lien per se. But that's interesting. Yeah, there are so many ways to structure deals. It's very there are a lot of options there, and sometimes you can make a deal work by like just the way it's structured.
Yeah, very, very interesting. So Philippe, as we're closing up here, how, let's say over the years, both of your professional career and now your full-time real estate career, how have your thoughts towards money changed over the years?
It's a very interesting question, because I think my first kind of awareness of what money was and how it worked is when I read Rich Dad Poor Dad. And the concept of the rat race, I was in my, let's say, late 30s at the time, and I was 100% living in the rat race. It's like I had, each time I wanted to invest, I had my 401k, but I didn't have like money to to invest in anything else. I was just like spending it. And the other thing, so that was like step one. Step two is when I read Millionaire Next Door, which brings that whole, so there's a whole study that they ran, with hundreds of millionaires, and actually like they make a very distinct comparison between people who are very conscious about saving money and building wealth compared to people who are just big spenders and who have no wealth. And it's very interesting. And I try very much to live by those principles, kind of mirroring the good habits of millionaires described in that book. I recommend it.
Yeah, it's very eye-opening, that book. I love it. Yeah, it's very interesting and very eye-opening. And when you read the back flap and they like give you a synopsis of what the average millionaire is, you're like, I got to read this, because it's completely different than, especially now with social media and stuff. I think I read it before social media at the initial time, but it was just like, it's great. It's a great read. Everybody should have. What do you think are the main factors that have contributed to your success?
Yeah, it's why what I say always to often to my students, it's I think consistency, consistency and focus, and so focus. I will start with focus. Focus is like, if you select a market, become the expert in that market. And I know I believe if you read Joe Fairless' book on syndications, he studied like 200 deals before he started to invest. When he started his career, 200 deals in the same market. He had like all the data point for 200 deals, and then when an interesting deal came up, that's how he knew it was interesting, because you had so much data to compare it with. It's this deal, in that location could make those rents, and now it's underperforming, and I can buy it, right now at this point and bring it to that level, and obviously make the returns. So that's focus, and consistency is, I think investing in multifamily, it's closer to a marathon than a sprint. So you really have to, put the effort, look at a lot of deals before you'll be able to take one down. So, be consistent, become the expert of your market. And, eventually maybe you'll find people to partner with, and eventually you'll succeed. All
right. So how can our listeners learn more about you and your business, Philippe?
Yeah, so they can reach out to me via email. So my email address is Philippe, it spells PHILIPPE @boostmycapital.com. And they can also come to our website at boostmycapital.com to download our 5 ways to, give me one second on this. 5 ways to boost your capital beyond your retirement account. That's how it's called. So come to our website, you can download our guide, ebook about this.
Great. Well, thank you so much for coming on today, and looking forward to connecting with you here in the near future.
Sounds good. Thank you, Charles. Thank you very much.
Talk to you soon.
Bye-bye.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.